Hey everyone, and welcome back to the channel. Today, we're tackling a topic that every single small business owner in the US needs to master: how to legally pay less in taxes. It's a shocking fact, but most small business owners are actually overpaying the IRS, sometimes by tens of thousands of dollars a year. So, if you're tired of watching your hard-earned money disappear every tax season, stick around. This isn't just about saving money, it's about funding your business's growth, your family's future, and your own financial freedom. Let's kick things off with the absolute foundation of your tax strategy: your business structure. This is a choice you make early on, but so many people get it wrong, and it costs them dearly. When you start out, you're likely a sole proprietor by default. It's simple, but it's often the most expensive from a tax perspective. This is a great step for liability protection, but for tax purposes, a single-member LLC is usually treated just like a sole proprietorship. You still face that same hefty self-employment tax bill. By electing to be taxed as an S Corp, you can fundamentally change how you pay yourself and, in turn, how you're taxed. As an S Corp owner, you pay yourself a reasonable salary. This salary is subject to self-employment taxes, just like before. But here's the magic: any additional profits from the business can be taken as distributions, which are not subject to self-employment taxes. Let's imagine your business makes $100,000 in profit. The remaining $40,000 comes to you as a distribution, completely avoiding that 15% tax. That's a $6,000 saving right there, just from one simple change in your tax election. Getting this right is the single most powerful move most small business owners can make. Now, let's move on to the second key point, something that sounds simple but is executed poorly by so many: tracking every single deduction. The IRS isn't going to find these for you. The responsibility is entirely on your shoulders. Missed deductions are literally just lost money handed over to the government for no reason. This can add up to thousands of dollars a year. Next up is mileage and vehicle expenses. Every single mile you drive for business is a potential deduction. Driving to meet a client, going to the post office to ship products, picking up supplies, it all counts. You can use the standard mileage rate set by the IRS, which is simple and generous, or you can track your actual vehicle expenses like gas, maintenance, insurance, and depreciation. Apps like MyLikeU or Everlance make this incredibly easy. You just turn them on and let them run in the background. At the end of the year, you'll have a perfect audit-proof log of your business mileage. Don't estimate this, track it. An estimation is a guess, and guesses don't hold up if the IRS comes knocking. But it doesn't stop there. What about all the software and subscriptions you use? Your accounting software like QuickBooks, your project management tools like Asana or Trello, your Adobe Creative Cloud subscription, your web hosting fees, all of it is deductible. Go through your bank and credit card statements and highlight every recurring charge that is related to your business. The deadlines are typically April 15th, June 15th, September 15th, and January 15th of the following year. Why is this so important? Because if you wait until next April to pay all your taxes for the entire year, the IRS will hit you with underpayment penalties and interest. They want their money as you earn it, not all at once a year later. It keeps you out of trouble with the IRS and gives you a much clearer picture of your business's true profitability. This leads perfectly into our fourth point, which is non-negotiable for any serious business owner. You must separate your business and personal finances. and go open a dedicated business bank account right now. If your finances are all mixed up, an auditor can argue that your business isn't really a business at all, but a hobby. They could disallow all of your deductions and even pierce the corporate veil of your LLC, putting your personal assets like your house and car at risk. Get a business bank account. Get a business credit card and use it for all business-related purchases. This creates a clean, easy-to-follow paper trail. It makes bookkeeping 1,000 times easier, ensures you capture every single deduction, and provides a powerful layer of protection for you and your family. And I'm not just talking about someone who prepares your tax return once a year. You need to work with a CPA or a tax strategist. What's the difference? They look at what you've already done for the past year and just plug the numbers into the forms. A tax strategist, on the other hand, is proactive. They're not just filling out forms, they're building a strategy. They see opportunities you'll miss because they live and breathe the tax code every single day. Don't try to be an expert in everything. Focus on what you do best, running your business, and hire a professional to handle the complex world of tax strategy. It's one of the best investments you can make. By understanding these incentives and structuring your business correctly, you can dramatically reduce your tax bill and reinvest that money back into your business and your life. And most importantly, get a proactive tax strategist on your team. These steps will transform your relationship with taxes from one of fear and confusion to one of strategy and empowerment. Drop a comment below with your biggest tax question, and I'll do my best to answer it.